The big thing to watch is AI. So with generative AI and then eventually with super, intelligence AI, ASI, artificial super intelligence, that's the next level of, AGI, artificial general intelligence.
Uh-huh.
With that coming out, we're going to see a lot of jobs get replaced through artificial intelligence.
Ladies and gentlemen, welcome to another exciting episode of our podcast. We are thrilled to have the distinguished presence of Greg Dickerson with us once again. Greg, a renowned business coach, serial entrepreneur, and real estate developer, requires no formal introduction as he has graced our platform on multiple occasions. With his exceptional expertise in investment opportunities, we have an insightful discussion lined up for today's episode, focusing on the economy, inflation, the multifamily markets, and exploring lucrative avenues for investments. Welcome, Greg.
Robbie, thanks for having me back.
Absolutely. Always a pleasure. And let's get started with what we usually talk about, your general take on the market, what's happening currently, what you see happening in the future, and then maybe focus on the state of multifamily and real estate.
Yeah, so the economy is still running strong. The Fed is still in their tightening, hiking cycle. Higher for longer is the theme of the day for the Fed. We have another meeting coming up in about a week or so. I don't know when this is going to air, but in the middle of June, the Fed meets again. And the speculation right now, or the betting by investors and economists, are that they're not going to hike this round, that they're going to take a pause. They're going to signal that they are going to watch the data information. That a pause doesn't mean that they're done hiking. It just means they're going to wait and let everything that they've done kind of settle in. As we know, the lag effect of the hiking is a big thing. But so far, they haven't really been able to make a dent in what's happening in the economy. The economy is running hot. The jobs market is still hot. Inflation is still high, but people are still spending. The consumer is still out there spending, traveling, doing things. We're seeing some layoffs, obviously in the tech sector, but we're not seeing layoffs at scale that could really affect the labor market with, the jobs reports and things like that, mainly at the, blue collar level where you start to see, layoffs that can really affect the economy. That's where you'll start to see them, the upper level layoffs, the tech jobs, Wall Street jobs, they're generally leaving with severance packages. Those are the ones that have been able to refinance and pull equity out of their houses to kind of sustain them. So there's a huge lag effect in the Fed tightening cycle. So I think they want to pause this time to kind of see the effects of what they've done already, unless, something changes between now and next week with inflation or something like that. But right now they're indicating a pause. So there's still a lot of work to do. Rates still need to remain a little bit higher to kind of cool things off. The market has rebounded really, really well since the Fed has started hiking off of the October lows. But we're not in the clear yet. We still have a little bit to get through, and the end of this year is going to be really, really interesting to see, what actually ends up happening.
Okay, interesting, because when I looked at the numbers recently, it looks like the Fed funds rate or inflation is approaching the Fed funds rate. So I remember we discussed this last time, but you mentioned when those 2 points intersect is really, that's where the Fed Reserve is going to decide to stop increasing the interest rates. And and it looks like inflation's coming down, but you're saying it's not on the way you look at it?
Well, so it's still high is what I'm saying. So obviously their target's 2%. Inflation is still, in their view, from what they measure, still, in the 5% range, plus or minus 5 to 6%. So the effective Fed funds rate has to be higher than inflation to really get inflation down. So we're just now getting into potentially restrictive territory when you look at it from that, refrain. So they have to get the Fed funds rate above inflation. The question is, are they going to ever be able to get inflation back down below 4%? That's the real question. And it seems like the consumer is kind of getting used to higher prices, which ultimately is a very damaging thing. What we're seeing is deflation right now. So we're seeing the rate of inflation, meaning prices are still increasing, but at a lower, slower pace. So prices are still increasing, but increasing slower. We're not seeing disinflation at scale. We're seeing it in a couple little areas here and there, but we're not seeing, what we need to be seeing, which is disinflation. What we're really risking is stagflation, where you have high inflation and slowing growth. That's what economists are kind of looking at coming into the end of the year, going into next year. So there's still a lot of work to do. And, inflation can rebound. I mean, we saw it happen, back in the 70s. So things could quickly turn around and flare back up again, if they don't get a grip on it quickly.
Okay. So would you say, compared to when we spoke last, which was several months ago, probably maybe the beginning of this year or late last year, are you more optimistic about how things are looking? Are you feeling the same? Maybe speak to that.
Yeah, so I'm always optimistic. It's business cycle. So the economy runs hot. The Fed has to cool it off. The economy slows. The Fed has to stimulate and speed it up. So it's just business cycles. Peaks and valleys. I think what we're looking at now is there's the markets. There's a lot of liquidity out there. So it's all about liquidity. There's still a ton of liquidity in the system. So now with the Treasury's general account needing to be replenished, that's going to suck some liquidity away from risk assets. The big thing that's happening right now is that credit is starting to really tighten. We didn't have that a couple of months ago when we were talking, because I think the last time we talked, we didn't even have the banking failures that we've seen.
Yeah.
We didn't have some of these things happen that have happened recently. So the banks have really pulled back. Credit is getting really expensive for real estate, for business finance, for consumer finance. So there's some things that are heading towards restrictive and in the more restrictive areas for monetary policy. But the big thing that we're facing now is the Treasury replenishing their account in conjunction with the Fed rolling off their balance sheet, quantitative tightening in conjunction with higher rates for longer. So that should really start to put the brakes on the economy as we get into the Q3 and Q4 of this year and Q1 of next year. We should really start to see those things really affect the economy and slow it down. What really is interesting right now is it looks like we may avoid any kind of a deep recession. Some people agree with that, some people don't. But at the end of the day, people are still out, they're spending money. The economy is still going strong. The labor market is still strong. So the stronger the labor market and the economy remains during this cycle, the better chances we have of a soft landing. However, not a lot of people or not everybody agrees with that. I think it's probably 50-50, across the spectrum of economists and analysts.
Okay. And you mentioned this, and I was going to bring this up, the bank failures. I mean, how does this play into where we are currently?
So banks are having a tough time right now because rates went up so fast, and most of them were invested in long duration, treasuries and things like that. So, they weren't able to hedge that very well. So that put banks under a lot of pressure. And then also people, taking their money out of banks and putting them into treasuries, putting them into money markets, putting them in the stock market, has had a big effect on bank reserves and things like that. So that's really the problem with the bank was, mismanagement of their reserves and mismanagement of their investments. The big thing that's weighing on banks now, and a lot of banks are taking action, is commercial real estate. So housing is still very strong, very healthy housing market. Most of the loans in the housing market are strong and healthy. You won't see anything happen in the housing market unless you start getting big layoffs at scale, at the middle management level and below, line workers, blue collar workers, things like that. People that, are really a paycheck or two away from default. If they start getting laid off, then you're going to see a potential problem in the housing market, but there's so little supply and inventory out there. It's going to take a huge event. The commercial market's different. So what the banks are doing now is they're already removing those loans from their books. So they're taking performing loans, just like your buildings, you're making the payments, everything's good. Right. Those banks are selling those loans at a discount just to de-risk their exposure to the commercial real estate space because there's so many things going wrong, especially, and going bad, especially like San Francisco. I mean, one of the largest hotel owners just walked away from a property there with supposedly $500 million in equity. They can't make the payments. There's nobody going to San Francisco. There's office buildings, retailers are vacating. So that's extreme. That's on the extreme end. But across the country, we're seeing office, that has taken a big hit. And then there's over $1.5 trillion in commercial loans that were originated over the last 3 years that are coming due in the next 2 to 3 years that have to be refinanced. And at today's rates, they can't without bringing a ton of equity to the table. So you're going to see all those assets go back to the lenders and people are walking away from those. So that's going to create stress on the banks, the lenders, the pension funds, life funds, insurance funds that are providing that debt. But it's also going to create opportunities for, operators and investors like you and me that are out there looking for assets that we can essentially just take over.
And now, how is this happening? Who are the banks selling these notes to?
So they're selling them off to other investors. So there's private equity funds, investment funds, pension funds, sovereign wealth funds, some other banks, because they're selling them at a discount. So some banks that don't have the exposure are looking at it as an opportunity. They look at the asset, they look at the note, and some of them are willing to take the risk on it.
And does that affect the sponsor of the deal?
Well, so does it affect the sponsor? So, in terms of your potential to get financed through those lenders again, it's probably not going to happen when you walk away from an asset like that. So it will affect you there. But there's other lenders, there's other capital out there. It'll be more expensive. Reputational risk obviously is a thing, but
Right.
right now it's at the higher level when you're dealing with billion-dollar assets. That people are walking away from. It's going to put a dent in your record, but you know you can recover it. I mean, we see Blackstone; they're walking away from stuff. So bigger companies like that, it's not really going to affect. But smaller operators, it'll definitely, put you on the blacklist, for a lot of lenders, but there's so many lenders out there and there's so much liquidity. And a lot of these funds like Blackstone and other, investment funds are putting together rescue debt. So they're coming in, buying non-performing notes, providing rescue bridge debt to operators, but those come with a lot of strings and some of those are a Trojan horse, to be taken over. So you got to be careful with that kind of stuff.
Very interesting. What you're saying is the housing market is strong and stable, and that's because many people refinance into historically low interest rates and they're holding. As you mentioned, the job market is solid right now, so we're not seeing a lot. We are seeing some layoffs, but not a huge amount of layoffs. And then also the multifamily market it's special in that it's backed by government debt, right? The Fannie and Freddie are supporting the multifamily market. So there's that there. But then when you start getting into industrial, office, commercial, retail, you don't have that government support. So I just want, looking into your crystal ball, like how do you see this all unraveling over the next few months into next year?
So the big thing for housing is, like you said, a lot of those people, have such low rates, they're kind of locked in. They can't really sell because there's nothing to buy. So that creates a problem. So if somebody needs to move, wants to downsize, whatever, what they're going to do most likely is, if they're moving and have to leave the area, they'll just keep the property, rent it out because they'll have such a great cash flow to help offset a rent wherever they're, moving to. In a lot of, areas, there's a big built to rent movement out there where, big home builders are building thousands of single family homes for rent. So there are some rental opportunities out there, but if you want to sell a property and buy another one, unless you're just going to move somewhere where there's very little demand and a bunch of inventory, your options are limited. So that's putting pressure on housing. It's also less affordable to own right now because of interest rates and other costs that have gone up than it is to rent. So that's creating demand for rentals. And as we know, their rents and occupancies are doing extremely well in most areas. Rents are coming down from the extremes that we saw last year a little bit in some areas, but rents are still going up in other areas. So, you still have an inventory problem in even a multifamily in a lot of markets, and you're seeing a lot of multifamily and development coming, through the pipeline, but there's still plenty of demand to fill them, especially in the states that are, seeing the most growth in the Southeast and, out west in Arizona, Nevada, those markets are starting to come back. So, when it comes to industrial and, commercial, you're going to see repurposing. So industrial, a lot of people have been flocking to industrial. In industrial, there's big industrial single tenant uses, there's flex space, then there's, storage falls into industrial, even though that's like a retail business within real estate, it's still under the industrial umbrella. A lot of capital, a lot of attention has been focused in those areas. But, with the economy, if the economy starts to slow and pull back, then the industrial will come under pressure because, most of it's being used for, last mile distribution, fulfillment centers, warehousing and things like that. So as the economy slows, those spaces aren't needed. And you'll see demand, kind of fall there. So that sector could come under pressure and is probably starting to in a lot of areas, from what I understand. But the biggest one's office. And, the only thing you can do with office is tear it down and redevelop, repurpose it, kind of like we saw with shopping malls. Big shopping malls, they're just tearing them down, repurposing, doing other things with them. Some malls, survived, other ones didn't. So you're going to see the same thing in the office. And, it's really interesting what's going on in that sector.
Yeah. Can you speak to that a little bit? Because that's the one that's, is most concerning in that more and more people are working virtually, less and less people are going to the office, especially in these big cities like San Francisco, New York, LA. I mean, how do you see this unfolding in the next several months?
It's all supply and demand. So until the workforce expands and, people need office space, but we've just overbuilt. We've overbuilt, overdeveloped. There's millions and millions of square foot of vacant office all around the country, all around the world because of the way the world has changed. We're never going back to work as we knew it, where you're required for the most part with most companies to go to the office, where you're required to work 5-day work weeks. I mean, there's all kinds of flexibility that's built in now, largely due to the demand in the job market, and the lack of available labor in the job market. I mean, people can just kind of call their shot. And if you've got talent and you're good, you can call your shots and say, hey, I'm going to work from wherever. And, you don't really have to in this day and age in a lot of areas, go to an office. So you're seeing companies really, really scale back, cut back. You're seeing the big bloated tech companies that are cutting, staff like Twitter. Twitter cut 75% of their staff and they're operating better than they ever had before. So that cuts down on the need for office space. So all of the tech companies are doing the same thing. The big thing to watch is AI. So with generative AI and then eventually with super, intelligence AI, ASI, artificial super intelligence, that's the next level of, AGI, artificial general intelligence. With that coming out, we're going to see a lot of jobs get replaced through artificial intelligence. And that's the new thing in the tech world now. In the tech world, it used to be you're hiring thousands of employees, you're growing, that was a sign of growth, just hiring and hiring and hiring. So now with the way the capital flow and the interest rate environment's changed, that's no longer a good thing. The best thing now is how few people can you operate with leveraging AI. So that's going to be a huge, thing that's going to really change the dynamics of the labor market and the requirements for officing for companies. So I think, at the end of the day, we're going to see office go the way of the old shopping mall. It's just going to get torn down. And we've seen it before, like in Vegas. You see huge casinos that become obsolete. Millions of square foot of casinos just get torn down and something new, gets built in its place. So I think you'll see a lot of those get replaced with housing. And then cities like San Francisco, that city, people are just leaving left and right. Retailers are closing. It's turning into a ghost town because they've just lost control of the city. It's lawless. They're just not doing anything about anything there. And people are they don't feel safe. They're leaving. And, the lawless, has taken over. They're just shoplifting. The companies are saying, don't try to stop anybody. The police won't respond. It's really sad what's going on, in that city. And until somebody takes it over and changes everything, people are just going to continue leaving.
Yeah. It's very unfortunate. Focusing on New York, I was listening to a podcast recently that was stating that there is some thought about converting some of this office space into multifamily, but the way these offices are constructed, it's very difficult to do so. Maybe only 5% of the offices in New York that are vacant currently could be converted to multifamily. But, that is an option, converting some of these offices to multifamily. What are your thoughts about that?
Yeah. So the floor plate, is your big determining factor. So, obviously a lot of offices are, huge and expansive, have a lot of columns and, you can't get window, if you try to maximize the entire thing and turn the entire floor into residential, you can't get windows in every unit, things like that. So obviously nobody's going to want an apartment or a condo with no windows. Yeah. So you might see some of those buildings where they just take the perimeters and turn them into residential. And the core just remains whatever, just remains dead space. That could be more efficient and cheaper than tearing the thing down or trying to, redevelop in some way. But the ones that are adaptable are being, adapted and being converted. But these giant buildings with giant floor plates that, don't have, that aren't conducive to that conversion. That's just what's going to happen. They're either going to just sit there vacant, they're going to get torn down, or they're going to adapt in however they can possibly adapt and where maybe you have some mixed use. So you've got the residential, around, then maybe the core can become some sort of retail or some other kind of use. But you're talking about a lot of square footage. And then, what's happening now is the newer buildings that are coming online, they're reducing rents to attract tenants. So people are leaving the older buildings, coming into the newer buildings. So, it's really going to be an interesting thing to see, what happens. But, like I said, they sit vacant long enough, they'll just start, tearing them down and doing something new.
Now, if we see, office vacancy increasing to 40, 50% come year's end or, the beginning of next year, what kind of pressures is that going to put on the economy in general?
So as far as the economy as a whole, it's a small segment. Commercial real estate's a small segment of the overall economy, right? You're talking about a $30 trillion GDP, the entire, value of real estate, across the United States. I don't know what it is, 100 trillion or something like that. But commercial real estate in terms of, the debt that's an issue right now is about 1.5 million. If you think about the square footage that's out there, if it just disappeared, again, they're just going to write down the debt and the property just sits. And we saw this happen in 2008, 2009. So we saw commercial properties, that were under construction, car dealerships, office buildings that just halted, stopped, condo buildings. We saw in Miami, all these huge condo buildings that were put up that were totally vacant, just sat there. And, it just worked its way through the system over the years until demand caught back up with that oversupply. And then we saw out west, especially, in Arizona and Nevada, places like that, subdivisions with thousands of homes that were vacant because nobody was buying them, that just got torn down. So, eventually, like I said, that's kind of what you're going to see. If office buildings, just become vacant at scale in cities like New York or Portland or Seattle or wherever the pressure is, they're just going to get, if they can't be repurposed, they're going to get torn down, or they'll sit there vacant until, there comes a day when, there's enough demand and enough growth, to fill those. But I just don't think you're going to see the demand for office space grow exponentially anytime soon because of all the things we just mentioned. The new remote work lifestyle that we are in, that's not changing. Artificial intelligence is just getting started. That's going to replace the need for workers in an office. Innovation in general, becoming more efficient in the workplace with the space that we use and, things like that. It's just fascinating. It's going to be interesting to see how this shakes out over the next, 2 to 3 years. We're going to see this happen over the next 2 to 3 years.
Yeah. Okay. All right. So in summary, you're saying that the office space is small enough in the overall scope of the economy so that it's not really going to have a major impact on the economy itself, but it's just going to, in its own sector, obviously there's going to be a lot of dynamic changes, and we'll see how this plays out in the next several years. A lot of vacancies, things of that sort.
Yeah. Now, if the entire commercial real estate market imploded, so retail, office, multifamily, and if they all hit all at the same time and everything started imploding, that could have, that could create some problems. But you're looking at a sprinkle here, a sprinkle there, a bigger problem in office. But, that debt for the most part is, the private banking sector, conduit, loans, life companies, pension funds, hedge funds. It's going to create a problem for pension funds, things like that need to pay premiums, and need to pay, payments to their retirees. But in terms of the overall economy, it's not really going to make a dent at this point. Again, unless there was some overall collapse and it just really started affecting banks. But it's a very small portion of the overall banking industry.
Let me ask you this question, Greg. There was, and I don't know if you saw this article, but it was in the New York Times about this one sponsor of large apartment complexes in Houston, and they foreclosed on 3,000 units because they're unable to make the debt payments. They were saying this is, one of many to come. What are your thoughts on multifamily and rising interest rates and the debt markets and how it's going to play out in the multifamily space?
Yeah, I mean, it's the same thing. And you're going to see, some of those are going to get foreclosed on. Some people are going to walk away from them. So that's going to create opportunities in multifamily. But again, it's not going to be at scale. That's going to represent a small percentage of the market where interest-only, bridge loans were done, where floating rate debt was done without a cap. Things like that. So, operators are going to come under pressure, and it's going to start trickling through over the next, year or two. We're already starting to see it happen. That was one group that they just way overpaid, they way over levered, and, they just had too high of an interest rate, and it caught them off guard because rates went up so quick. But like I said, even in the hotel sector, that largest hotel owner in San Francisco just walking away. And, that loan was only, so the building, I think, was over $1 billion. The loan was only like 500 or 700 million. So they're essentially walking away from potentially all that equity. But, when you look at it from that standpoint, was there really equity? I mean, what was that really worth? If they can't make the payments, he's walking away. So that's really what happened. So in that case, what you're talking about, all of the equity investors that invested with that group got wiped out. So when a multifamily operator walks away from a deal like that, all of their investors get wiped out. So that's where you're going to see, the biggest brunt, of the impact. It's going to be on individual investors. It's not going to affect the banking sector. It's not really going to affect the economy. It's going to affect private investors, which is your, shadow banking industry, will take a little bit of a hit there. And then the results is tighter credit, tighter lending standards and things like that. So we're already starting to see that, just like we did in the pandemic.
Yeah, absolutely. I'm going to ask you one more question before we get to opportunities here in this market. But we spoke last time about the Ukraine war and its effect. And, things were uncertain at that point. Things are still uncertain, but, obviously this has progressed over the past several months, and we kind of see how this is affecting the economy. What's your take on the Ukraine war and what kind of pressure it's going to put on the markets and what kind of effect is it going to have?
Yeah. I mean, as long as Ukraine prevails and the conflict can be ended in the next year or so, I think, things will work out from a global, macroeconomic standpoint. But obviously there is potential for that to escalate, China and Russia coming together in the whole BRICS thing with, China, Brazil, Russia, India, Saudi Arabia, with those countries coming together, that could create, some problems. Obviously, there's a big de-dollarization conversation going out there, with some of those countries trying to get away from the dollar. But, at the end of the day, the biggest risk is potentially China and Russia coming together and joining forces and creating a bigger problem. I think we've got big risk with China right now and potentially another conflict breaking out there. And that if that happens, things could spiral out of control quick because that's going to trigger NATO, and then it's a whole big mess. So the hope is we can, control and contain everything to Ukraine, resolve that, eliminate Russia's ability to do what they've done, weaken them significantly, and then that new world order gets created where it's us and China and, Russia, unfortunately is just, they've cost themselves, a position on the global stage now. And, I think they're ultimately going to be defeated. The question is, how long is that going to take? How much is it going to take in terms of dollars spent and lives lost and those types of things? But, right now, unless, Putin loses it and just starts, breaking out the nukes, I think it's just, it'll come to an end and Russia is not going to win. And, that will get resolved.
Yeah. Well, our heart goes out to all those affected by this tragic incident here. And we're thinking about them, and it's just so unfortunate how this is playing out. But to your point, we're all hoping that this will end soon and Ukraine will prevail and it will just change the world order and stabilize that area. Okay. So now moving on to opportunity, where do you see opportunity now? Where do you see opportunity? Let's keep this maybe in the short term, in the next year or so, or maybe early next year. Where do you see opportunity now? Where do you see opportunity?
So the biggest demands are for housing and for rental units, so that's your big demand right now. So that's where your opportunities are, and the opportunities to create housing because there's so limited inventory. So from a development standpoint, creating lots for developers and builders to build on, doing some entitlements to get projects out of the ground for multifamily. There's very little transactions that are able to be done right now because of pricing and interest rates. 80 transactions are down like 80% across the country. So development multifamily is a good place to be right now. And then ultimately, as these distressed assets work their way through the system, then there'll be opportunities to take those over and, jump in. Some of them you'll be able to assume the debt. Some of them you might have to bring a little equity. But at the end of the day, if a lender wants to get rid of an asset and you're a good operator with a balance sheet, you can just walk in and take that debt over and not have to put any money down.
So how would that transaction happen? How could somebody, walk up and take over the debt? How would that work out?
So two ways. One is, an operator, like an investment bank like Blackstone, Goldman Sachs, somebody like that calls you up and says, hey, we have these properties we're getting rid of in our portfolio. The loans are assumable. We're walking away from them. Here's the lender contact, and they put you in touch with the lender. That's one way. The other way is lenders directly. So, there's, lenders that have their special assets division that are dealing with these properties that are in default and that are going back to the bank, the REO departments, working with them directly and, working out a deal with the bank directly, to take that loan over or get it refinanced with another institution.
Okay. So, there's opportunity with distressed assets for sure. What about just general assets? The cost basis has dropped significantly over the past a year or so. We're seeing drops, that probably 20%, 30% from the peaks. There are transactions happening. As you mentioned, they're few compared to where they were previously. Do you see opportunity in buying now versus waiting for several months to a year?
Just depends on your goals and your time horizon. But, at the end of the day, if the deal makes sense, if you can service the debt, return, on the equity that's invested, then keep on going, because that's really what matters at the end of the day. And then you can refinance later when rates do come back down at some point, because they will. Again, it's business cycles, right? We've seen this before. The question is, how low will rates get? None of us ever thought they would ever get as low as they did. But, if we get into an extreme condition, you could potentially see that again. So that could create opportunity. So, I would say if the deal makes sense, it looks good, you can pay the debt, you can pay the equity investors, and you've got a good long-term, opportunity to increase the value, absolutely. You definitely want to keep doing deals.
Yeah. And the way we think about it as well is, you've got the cost of the asset and then you have debt, right? And the cost of the asset is fixed. The debt can change. You're buying at a low basis and you're selling at a high basis. You're going to make money there, obviously, most of the time, unless you really screw up the debt piece. But, the way we see it is there was tremendous amounts of interest in buying, maybe a year and a half ago, and people are paying insanely high prices, and a lot of investors were coming in trying to buy those or participate in those types of deals. And now people are more hesitant and scared. But when other people are fearful, you become greedy because there's opportunity there. And what we're seeing is the cost basis has dropped considerably from some of these assets. A lot of people are not, their pencils are down. They're not even underwriting deals. We're seeing deals coming up with high cap rates that are cash flowing, positive leverage. I mean, it's what we're seeing is great opportunities. But the other problem with that, though, is sometimes the sellers, they're putting their deals on the market to see if garners interest, and it does, but maybe they're not hitting their strike, and then they just pull out. So we're seeing a lot of that too.
Yeah. Still a lot of price discovery going out there and a lot of stubborn sellers. And it's going to take time. I mean, because the thinking is, this has just been really this year that all this has started happening. I mean, they just started hiking rates. What? Has it been a year yet? I don't think it's been a year, since we started the hiking cycle.
Yeah.
It's getting close to it. But so, it takes a while for this to roll through, and you're going to need rates to remain higher for a lot longer. You're going to need the economy to really change. And then you need, at the end of the day, you need a motivated seller. So, if somebody has to sell, they have to sell. And if they don't, and, right now, a lot of those sellers aren't motivated. So they're just going to test the market and see what's going on. The problem is that people can't pay what they were paying before because they just can't get the financing without bringing extra equity, to the table.
So if you could, you could look in your crystal ball and you discussed what your projections are in the future, but looking at your crystal ball, when do you see the opportunity unfolding? When should people be really ready and prepped with cash on hand to purchase some of these assets?
Well, I would say, so the next 2 to 3 years is when the bulk of that 1.5 trillion is coming due. Over the next 2 to 3 years, we're starting to see some of it now. So from here, to the end of the year, going into the next year, as far as the economy goes, we're going to know really well where we stand from a recessionary standpoint by Q4. So, by the end of this year, going into the fall, into the winter, we're going to really know where the economy stands and whether or not we're going to be able to avoid a recession, what layoffs look like, things like that. You still have, revenge spending, revenge traveling, all that going on. We're in the summer. There's so much liquidity that was created with people refinancing their houses, refinancing their properties, things like that created a cushion. People that are getting laid off are getting laid off with, packages at the higher levels, the banking and the tech sectors. So, everything's kind of delayed. It takes time. Even in 2009, that was the great financial crisis. That started in 2007. A lot of people don't realize that. The distress started in 2007. And it took till 2009 to get to the bottom until things really started imploding. So, we are in the beginning stages of a potential financial catastrophe that can be averted. If it can be averted, we're going to know by the end of the year whether or not it can. If not, you're going to start to see real stress, real cracks, and the real systemic incidents start to happen by the end of the year, I think.
Okay. So overall message, be cautious, be careful. If there is an investment that makes sense, you're able to cash flow well, cash is king, able to cash flow well, pay debt service. You're buying at a low cost basis, go for it. Obviously, don't push the limits here. Just be very careful and cautious until maybe the end of the year, early next year, when you see how things are really unfolding. And depending on that, you can make a decision whether to really move forward and invest heavily versus continuing to hold and watch and wait.
Yeah, that kind of sums it up. And then, as far as the, traditional markets go, stocks, crypto, things like that, the markets have recovered well since October. And, if we can avoid, any kind of a recession or deep issues in the economy, the markets can kind of, they're kind of carving out a little path here. The AI boom has, provided a lot of steam to the markets lately. So, there'll be some opportunities in the markets as well. And again, we're going to know a lot more here Q3, Q4, where we stand with the markets, the economy, fiscal policy, all that kind of stuff.
Excellent. You brought up AI a couple of times. Any opportunities in investing in, the AI space?
Yeah, there, as far as individual stocks go, you see what's been happening there with NVIDIA exploding and things like that. I think it's a little early yet. I think it's a little overblown, a little overhyped. So I think you'll see some of that start to pull back. Just like we saw with Apple releasing their headset and their version of the metaverse headsets and things. There's a lot of hype out there still. So I think it's early for all that. I don't think we really fully know where the whole AI thing is going to go and what its real capabilities are. And again, the big game changer in AI is going to be artificial superintelligence. That's where AI becomes way smarter than even humans and way more capable than even the human brain. That's the scary stuff. That's the stuff you see in the sci-fi movies.
Terminator.
So for any, so look into ASI, artificial superintelligence. Now, the conversation there, it takes such huge computing power that some people think it's 5 or 10 years away. Some people think it's 50 years away. So, that's kind of where that's going. But you got to look at the different sectors in terms of, so when you're looking to invest, okay, you want to think about network effect. Okay. Network effect, meaning YouTube, Facebook, Apple. Where are the people going that are utilizing these services? Where is that network effect? You want to invest in that. So when you're looking at AI, look at that. Like NVIDIA is a chip maker. The reason their stock boosted is because they're the only one that has the chip for the GPU that powers AI. So, eventually somebody else is going to start making those chips. Apple's going to, make their own AI chips. Google's going to make their own. Tesla's making their own. So eventually, that NVIDIA, market share is going to slip. So you got to make sure that what you're looking at has real network effect that's long lasting, where everybody is using it. Everybody's consuming it. Those are the types of things you want to invest in. That's your Coca-Colas. That's your Nike. That's your Apple, Google, Microsoft, those types of things.
And just focusing on super AI for a second, because I haven't actually heard that term before. Using Chat GPT, I already know it's way smarter than I could ever be. And taking that to another exponential level, I can only imagine what would happen. But where would this technology be used? Where would super?
So, artificial general intelligence right now can't think. So it just produces information based on, a collation of information, right? And even ChatGPT is limited up to 2021. So all it can do is scan what's available up to 2021 and give you an answer. So it's not smarter than you. It has the ability to collect the data and put it together faster than you. What artificial superintelligence can do is now take that and come to its own conclusions and think, and then learn based on other inputs and aspects, and even maybe start to have some emotion in there as well. So that's what's really interesting about artificial superintelligence versus artificial general intelligence. Again, that takes super computing power that we don't have the ability to do yet, but that's what the space is already talking about, looking at for the future.
Yeah. It's crazy to think about. I keep on having flashes of Terminator, the Terminator movie series in my mind when I hear about that.
So that's the big difference. The technology doesn't have the ability to think yet. Once it has the ability to think like we do to different levels, that's scary.
Yes. Yeah, it is. What's interesting, when you're talking about all this stuff, what we have in our heads in this small space here is the supercomputers that have taken us, so long to develop. It's we have the ability to obviously, think and assimilate information on our own and make decisions. And it's amazing what we have already. Kind of makes you appreciate that even more.
And the funny thing is, we don't even use, what do we use? 10% of our brain power?
Yeah.
Something like that. Imagine if we could somehow leverage AI to tap into that and start using, 50% of our brain power. Then what happens?
Yeah. It's amazing to think about. Well, Greg, this was phenomenal. Thank you so much for your time. And, I love having you on the podcast because you offer so many amazing insights. Any parting words to share with our audience?
Yeah. So, like I said, business cycle. So just understand where we are in the cycle, peaks and valleys. When the economy's running hot, you got to slow it down, cool it off. When the economy's, running slow, you got to speed it up and stimulate. So we're just going through the business cycles, but there are some big things out there like the debt, all of the leverage in the system and liquidity that's been created and things like that just kind of have to work their way through. And obviously the attack on the dollar around the world and things like that. So there's some things that you got to be aware of. But at the end of the day, there's opportunities in every environment. You just got to understand where we are in the cycle and, just make sure you're ahead of that.
Excellent. Thank you so much. And if somebody wants to contact you, reach out to you, how could they do so?
Yeah, GregDickerson.com. That's where all my info is. Go check it out.